Welcome back to another episode of Debits and Credits with Haas and Dawe. And today we're going to leave the escrow world of talking about escrow transactions in real estate, and we're going to talk about a tax concept, the pass-through entity tax, known as PTET, but that acronym is too hard to stumble my tongue over, so I'm just going to say pass-through entity tax. It came about after the 2017 Tax Act, where the state and local tax deduction, we call it SALT in our world, the state and local tax deduction on Schedule A of itemized deductions was capped at $10,000. This is where people could deduct their state income tax and their property taxes and take it and get a deduction for them. Well, what the government said, and when they came up with this 2017 Tax Act, because they were making a lot of other concessions and they needed to try and balance out the budget, they capped the state and local tax limit at $10,000, which had a big impact on high income tax people because they could no longer deduct the taxes that were coming through from paying state estimate tax and paying a lot of taxes through withholding when they were high income people. And so they wanted to find a different way to do that. So it started in Connecticut and it has morphed through all the different high income tax states across the country. Or what they came up with this concept is that if you have a pass-through entity, like an S corporation or an LLC, a limited liability company, that you were a member of or a shareholder of, what they would do is they'd have those entities pay state income tax to the state in which they're located, and that would create a deduction on the federal tax return because state income tax is allowed as a deduction on a federal tax return. And then when you received your K-1 from the S corporation or from the LLC, your federal tax income amount would be lower because the K-1 would be lower because it's reflecting the state income tax deduction. And then you wouldn't have to be trying to worry about having a cap on your Schedule A itemized deductions for not for having paid in state income tax. And then on your state income tax return, what would happen is the amount that was paid in for the state by the S corporation or the LLC would show up as a credit to you. It's as if you had made an estimated tax payment through this pass-through entity, and you could claim the credit on your state income tax return. Well, the IRS got wind of this and they fought it, but they couldn't get it completely defeated because there was nothing illegitimate about the process. And so it still exists today. Now what's happening is that again, the pass-through entity will make these deductions, and then the deduction would pass through onto the federal tax return, and the individuals would be able to take a deduction because they're going to have a lower K-1. Now, what's happened is the states were trying to figure out how to do that and regulate it on their own. And when it came to California, when they passed their first law with it, they got it wrong, so that in February of the following year they had to amend the law retroactive back to the year before so that the people in California would get the benefit of this pass-through entity tax. And it was a little bit of a mess the first year of filing. It seems to be in place now on somewhat of a consistent basis, but it still has some nuances to it and some rules that have to be followed. It gets to be a little bit complicated because even as much as it sounds like it's a great deal in that you get your state tax paid for you, and then you can take a credit for it on your state tax return and a deduction on your federal tax return. There are some quagmires you have to get through because it could backfire and not benefit you. Now, one also caveat to throw out there is that when the tax bill got passed last July, the new tax bill in July of 2025, which was mostly an extender of the 2017 Tax Act, because a lot of the provisions of the 2017 Tax Act sunsetted in 2025. So in this tax bill from last July, they raised the limit on state and local income tax from 10,000 up to 40,000 on Schedule A itemized deductions. So this is going to make it not necessarily as attractive for everybody to claim or to elect in this pass-through entity tax at the S corp or the LLC level. So that's something that your tax providers and the company tax providers will need to check on to see if that makes sense to do that. Now, here are some of the quagmires. Here are some of the sticking points of this pass-through entity tax. First of all, it's computed at 9.3% of the California taxable income of the entity. So if it's an S corporation, it's the taxable income of the S corporation. If it's an LLC, it's the taxable income of the LLC, and it's 9.3% of that taxable income, of that net taxable income. And that tax has to be paid by the entity. There's no way of picking and choosing how much you want to pay in. It's 9.3% of that taxable income, and it goes to California, and they're holding your money. The other thing that you have to consider is then it gets to the individual. Okay, so they've elected to do the pass-through entity tax, and it goes to the individual, and then the individual can claim it as a credit on their individual state income tax return. Well, here it becomes an issue that, let's say that person doesn't need the entire amount of that credit because the amount that paid in, the 9.3% that's passed through to this individual, is more than they need for their state income tax return. And so they've overpaid. Well, if it's from the pass-through entity tax credit, they can't get a refund of that. It carries forward because it's a credit, not an estimated tax payment. And so the credit carries forward for up to 5 years. And if at the end of the 5 years, if you haven't used up all the credits, you lose it. And then California has gotten a sort of a free payment if this credit hasn't fully been used by the individual taxpayer. So you have to be careful about whether it's something that makes sense to you to use or not to use. Now, going back to the calculation, the 9.3% of taxable income, a couple of other points that need to uh, be in place is that by June 15th of the taxable year, so for example, for 2026, by June 15th of 2026, those companies that want to elect in for the pass-through entity tax have to make a payment by June 15th. And the minimum payment that's needed, it's either $1,000 or 50% of the pass-through entity tax that was paid for the prior year, meaning for 2025. That's got to be paid in, with the balance being paid with the due date of the tax return, which is March 15th of the following year. The other thing that makes one has to consider is whether it makes sense to do it, makes sense not to do it. If you're a single owner of the S corporation and your state income tax isn't that high, where 9.3% of the taxable income is going to um, benefit you because it's way too much more than you need paid in, then you should think about not doing it. There are other options that are available. So let's say there are two people or three people who are shareholders who are members of the LLC. Not everybody has to opt in. As a member of the LLC or as a shareholder of the S corporation, you have the option to opt in or opt out. Now, if you opt out, it means you're not going to get a credit on your state income tax return. You're not going to get any of the credit that's being paid in by the entity. But let's say you have a member who has opted in. Okay, well, that means the company's going to be opting in to do the payment. And so the calculation is going to go forward 9.3% of the taxable income of the entity. And so, again, in the end, in this case, California would receive this payment of 9.3% of the taxable income. But then what would happen is the owners who opted in would get the credit. So let's say there are two people and one's opted in and one is not. The one person who's opted in is going to get the benefit of the entire payment going in. Now, where it gets confusing, though, is on the K1 that's going out to both members because it's a deduction. It's a deduction to the corporation, or the S corporation, or to the LLC. It's a deduction to the entire entity. Therefore, the K1 is going to reflect that the share of the federal taxable income net of the state deduction, the state payment being made, goes to everybody. It's not like you can force the K1 for one person who's getting the credit. They don't get the entire deduction. All owners get the benefit of the deduction, but only those owners who opted in are going to get the benefit of the credit on their personal tax return. So this is in place right now. The other thing that we caution people on as their state income tax deduction grows higher on their Schedule A, there's this thing called alternative minimum tax. That's an alternative way that the government calculates tax because they're trying to get the people who are taking advantage of tax fringe benefits or tax loopholes, however you want to look at it. where they were able to get down their tax very low, they come up with a way to recalculate the person's income, remove the loophole, and come up with a flat tax of 26%. And one of the loopholes, so to speak, was people were claiming a lot of state income tax deduction on Schedule A were falling into this alternative minimum tax. So now we're cautioning people, be aware of what's happening, that this AMT, this alternative minimum tax, may come back to bite you if you're not careful about which way you go as far as claiming and not claiming the pass-through entity tax, how you pay your state taxes, and so on. So that's the pass-through entity tax. It's still out there. It will in California's legislation, it'll stay in place as long as there's a cap on Schedule A itemized deductions, but it's still something that's in place and something to be aware of. That's the latest on the pass-through entity tax from Haas and Dawe. We'll see you next time for another edition of Debits and Credits.